Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Welcome to Many Happy Returns, where we aim to make you a better investor. For 2 decades, calling a UK house price crash has been a reliable way to look clever and be wrong. But while nominal prices have barely moved, a slow grind is reshaping affordability, rents, and the house building sector.
I want to know if the correction has finally arrived, just not in the form that makes headlines. And in today's dumb question of the week, are short-term fixed-rate mortgages a problem? All right, let's get into it. So let's talk about house prices, Romin, everyone's favourite topic in Britain. And we've put crash in the title, partly because we think it might get clicks, but partly because there kind of is a real terms crash going on. But before we dive into the data, I thought, let's start with an anecdote. Let's start with a story from the press. Now, there was a very indicative article in the newspaper over the last week, and it was titled, "At 70, I'm trapped in my £850,000 family house and I can't sell it. No one is biting. I wonder why that could be." It seems that the problem was some estate agent told her it was worth £850,000 a few years ago, and she's anchored to that number. But the final paragraph in the article, she says, "People have asked me why I don't just drop the price again, but I refuse to give my home away cheaply just because of the ridiculous economic climate we're in. With a government that fails to support hardworking people. They incentivize first-time buyers, but what about the people who want to move their families into bigger homes and the ones like me who are desperate to downsize? Where is our help?" What do you think? Bailout for the boomers?
Yeah, it's obviously the government's fault. Look, I mean, this shows the psychology of the UK average householder, which is that house prices only go up, and you'd never have a situation in which you'd have to consider reducing the price at which you're selling, or take that as a signal that the price you've set is too high.
So where are we right now as a country in terms of the housing market and where prices are going?
Well, the way we usually measure this is looking at the value of a house relative to the average income in the area in which the house is located, the house price to earnings index. And certainly over recent years, it's been at record highs, and it's shown very little sign of correcting downwards, which for first-time buyers is incredibly painful because they just can't get on the housing ladder. Now, I think part of that was very low interest rates for a very long period of time. And it's also driven by a frenzy after the COVID shutdown where people wanted more space, and that pushed up house prices again. And we've had a spate of housing policies from every government trying to artificially improve those prices.
So let's have a look at the house price to earnings ratio back through the decades. So if we go back to, let's say, the mid-90s, the house price to earnings ratio was around 4 times, i.e. a house cost 4 times the average annual salary. Then we had a rapid run-up through the latter half of the 90s and the early 2000s until it reached around 8 times. So it was a doubling of that ratio. And it's been bouncing around there ever since, really. Though over the last year, it has come down from 8 times to around 7 times. It depends exactly what stats you trust, but if you look at the ONS or if you look at Nationwide's data, they do track each other pretty closely.
Yeah, so still expensive, but not quite as expensive as it was after we had this recent softening. And if you look at the regional breakdown, that's kind of interesting too. The places where house prices have re-rated, i.e. relative to their earnings in the area, are the ones which are where it was most expensive. And essentially, you could draw a line across the country between the southeast, particularly London, and the rest of the UK to look at where the house price to earnings multiples were highest. And that's where the D-rating has been largest.
Do you think we should draw that line like a new Hadrian's Wall? Just build it?
Well, effectively, you've drawn a line where first-time buyers can't afford to buy unless they've got either very rich parents or ridiculously high salaries compared to the rest of the population.
Yeah, I was actually looking at stamp duty, particularly when it comes to first-time buyers, and where that's paid, because there is an allowance, like a minimum threshold, and it's basically a tax on London and the southeast. I'm not saying it's wrong, but that's just the way it is because of house prices being significantly higher in that part of the country.
But that's reassuring to see. Where the wealth is, there the tax should be also.
Is it reassuring, though, when you've got two kids who presumably eventually want to buy in London and South East? How far is your pension pot going to stretch, Romin? This bank of
Well,
mum and dad.
this bank is not going to bail them out, unfortunately. I haven't told them that yet. Perhaps I should. Fortunately, they don't listen to this podcast, so they'll never know.
Well, they'll know at the time they come to you with the begging bowl. But anyway, that's future Romin's problem. So why are we talking about a crash here? If you're saying the house price to earnings ratio has moderated slightly, but it's still very high, well, let's look at the prices. So as we said at the very start, nominal prices are very close to their all-time highs. The nominal peak was in the summer of 2022, in that kind of COVID mania, the rush for space. Then we had a dip of around 6% or so in nominal prices as rates rose, and it's recovered a bit to be almost back to where it was in 2022. But if you look at real terms prices, where we adjust for inflation, then they are down anywhere between 15 and 18%, depending on what house price index you use and what inflation numbers you use. So maybe it'd be fair to describe it as a real terms correction rather than a crash. But it has happened.
But a comment I always get if I make a video about house prices is look at the regions, because they are massively different in the UK. It's like we've got two different countries. So, for example, if you look over the last year, leading up to February 2026, Yorkshire and the Humber, house prices there are up by almost 4%. Similarly for the North East and the North West. The real standout is London, which is down by over 3% year on year. Also the South East down by about 1% and the South West.
And these are nominal figures, obviously.
Yep, these are nominal.
And if you remember, inflation's running at more than 3%, then we're looking at 6 to 7% falls in London and the South East over just a year. And I would say even within London, it's kind of a massive division between the inner and outer boroughs. There was an article in the FT last week. House prices in London's wealthiest boroughs suffer double-digit decline, where if you looked at Westminster, for example, it was down nearly 13% year on year. Kensington and Chelsea down 11%. And for these prime parts of London, prices actually peaked a long time ago, possibly in like 2014, 2015. And if you adjust for inflation, some of these boroughs, the prime properties in them, have fallen like 40% in real terms over the last decade.
And it's always worthwhile looking at the drivers of the housing market. We've already discussed how leverage is important for house prices. And if interest rates go up, well, clearly that's going to cause a derating of property. And that's precisely what we've seen. We've gone from a world of zero interest rates to one in which we have kind of normal interest rates. And although interest rates have been falling after the post-COVID peak and the Bank of England's attempt to stave off inflation, now it's gone back into this state of flux where it'll probably remain anchored where it is until what happens in the Strait of Hormuz gets resolved. And I think here it's really clear how the UK as an open economy is massively influenced by things which we can't control. Geopolitical events, the cost of oil, and how those feed into interest rates, which a lot of people, I think, are really surprised by. We can't afford to be like Americans, where we don't really care about what's going on in the world, because we're exquisitely affected by all of these shocks.
And I think that's the point, which explains why prime central London has been affected in terms of house prices worse than the rest of London and the rest of the country, is that it's very exposed to the flows of capital across borders. And it's no coincidence that the non-dom regime was abolished in 2025, which meant that London was relatively less attractive compared to some other international hubs like Milan, Dubai, Switzerland. Also, we've had sanctions on Russia, and we've had the stamp duty surcharge for additional properties raised from 3% to 5%, as well as loads of speculation about wealth taxes and things like that. So London's had a little asterisk next to it for those super rich people. And therefore, we've seen a crash, a genuine crash in prices in Westminster and other central boroughs.
So that's the kind of shorter term driver. I'd say another one, which is certainly important over the long term, is wage growth. And in the UK, we just haven't had very good wage growth over the last 2 decades, say. We had seen it improve recently over the last few years in real terms. And things were looking really promising until we got this stagflationary shock due to oil prices increasing. So that's another thing which is going to negatively affect house price growth in the UK. And it was really upsetting to see that kind of rekindling of growth and falling of inflation essentially be snuffed out by this event. And this is going to be one of the consequences, which is weaker house prices.
Yeah. In the newsletter last week, we looked at the early warning signs around inflation and whether we could get a second spike. And there are all sorts of leading indicators where you can look at business surveys and input costs and things like this. And they're all flashing red right now. So it would be surprising if we didn't see a relatively significant pickup in inflation over the rest of the year. Maybe not to the sort of double-digit level, but up to maybe 4 or 5%. And obviously that has consequences for rates. Markets are still pricing in rate hikes.
So currently, every year, we've got about 800,000 fixed rate mortgages with an interest rate of 3% or below, having to refinance and having this interest rate shock as they have to service debt at a higher rate. Now, that's not going to make you think, oh, I know what I'll do. I'll go and buy a new house, because you'll be thinking, I've got to service this debt now. I'm not going to pay more for a new house.
Yeah, it feels like we've been talking about this phenomenon for a while now, haven't we? Because we have a lot of 5-year fixes in the UK, that it takes a long time for this to feed through into the market. So if you fixed your mortgage in 2021, then at some point this year, you'll be looking to refinance. And that very low rate will no longer be there, will it?
Yeah, we fall into that bucket. So we're going to have to refinance at the higher rate. And it's not going to be pleasant. It's going to be much more expensive. But it's not just the housing market which is affected. Presumably, that's going to affect the whole economy. Because what you're really doing here is taking money out of households' discretionary spending.
And it's quite a change from where people expected us to be, right, Roman? So rates have been on a stepped withdrawal from that peak of 5.25% that we reached after the pandemic. And I think people were expecting that to continue, maybe with another couple of cuts over the rest of the year. But as we said, that's all gone out of the window. And I think people's hopes for 2026 as a recovery of the economy and of the housing market are not going to be fulfilled, are they?
It's looking unlikely. And I think the longer this crisis goes on in the Middle East, the more difficult it's going to be for the UK. Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Trading 212 Stocks and Shares ISA is the cheapest way to invest, with zero commission and one of the lowest FX fees I could find on the market. Looking to keep things simple, you can easily automate your investing with pies that allow you to rebalance your portfolio at the click of a button. Customers with Invest accounts can also benefit from the Trading 212 card, which has no FX fees, true interbank rates, and offers 1.5% cashback on all transactions up to £15 per month. Many Happy Returns listeners can claim free fractional shares worth up to £100. Just create and verify a Trading 212 Invest or Stocks ISA account, make a minimum deposit of £1, and use the promo code ROMIN, RAMIN, within 10 days of signing up, or use the link in the show notes. When investing, your capital is at risk and you may get back less than invested. Past performance doesn't guarantee future results. Pies and Autoinvest is an execution-only service, not investment advice or portfolio management. Automatic investing refers to executing scheduled deposits. You are responsible for all investment and rebalancing decisions. Free shares can be fractional. 212 cards are issued by Paynetics, which provide all payment services. Trading 212 provides customer support and user interface. Terms and fees apply. But if we do attempt to look forwards rather than backwards, I think one way to do that is to decompose house prices into two components. One of them is that price to earnings multiple. What's the price of the house relative to income in that area? Now there, what we'd expect is mean reversion. That's what usually happens. So we'll be moving closer towards the long-term average, which is what, 5 times? Maybe even lower. So that'll be a gradual move downwards. And then we've got the effect of incomes themselves. How quickly are those going to carry on rising? So there, probably the central case is 4% growth, and the downside could be falling, right? So we could have wages falling in real terms. So those two effects, I think, are going in the wrong direction. The re-rating downwards, the slow effect, and the effect via wages, which is potentially going to be quite sharp and unpleasant.
So your central case sounds like a continuation of what we've seen over the last 3 or 4 years, like house prices grinding down slowly in real terms.
And then if this geopolitical shock turns out to be fairly long lasting, yeah, then we could have a shock downwards.
There would be a long way to fall if the house price to earnings ratio normalized to the long-term average. But it's been elevated for a very long time, so it seems unlikely that it goes back to 5 times earnings, no?
I think so. And I think people's expectations of the price they can sell at are what keeps it anchored.
Is it the expectations, or is it the fact we just haven't seen much forced selling? Unemployment remains low. A lot of people own their houses outright in the UK now. We've got a whole load of policy around mortgage forbearance when things do go wrong. So it's pretty rare that the bank takes someone's house and puts it on the market, or people are just forced to rush panic sell their property.
Yeah, if you look at the 4Ds for moving, so that'll be death of a spouse, debt, divorce, and having to downsize. There'll be a certain amount of turnover driven by the 4Ds, and those people may be forced into moving. But if you've got the choice, I think what a lot of people are doing is just staying where they are.
Yeah. Where we have seen like semi-forced selling is from landlords, buy-to-let landlords, where a lot of government policy has moved against them. Tax is less favorable than it was. Renters have got new protections. Obviously, rates have gone up as well. And so a lot of landlords are finding that the sums just don't add up anymore. And we have seen a lot of disposals.
Yeah, I think you're right. Conversations that I have with people one-to-one in coaching sessions, it's pretty clear those landlords have stepped back from the market. Some of them have sold their portfolio completely and moved it into the equity market, say.
And a lot of landlords owned flats and rented those out. And that's the bit of the market that seems to have been hit worse than any other for a few reasons, really. We've got the fallout from the Grenfell disaster, where a lot of high-rise buildings have had to have cladding works and replacement. And in the meantime, most mortgage lenders are skeptical about lending against those properties, so it's hard to sell them. We've also had a lot of problems with leasehold as an ownership structure and escalating service costs. So if you look at the breakdown, flats are performing far worse than freehold properties. So over the last year, flat prices on average have fallen 2.6% in nominal terms, whereas detached houses are up 1.6%, semi-detached 2.9%, and terraced 1.8%. So it's flats that are really dragging everything down, although nothing is up in real terms.
And if you look at the annual inflation rates in rents, those have also come down massively since peaks in 2023. So rent inflation was almost double digits in 2023. Now that's fallen to around 3% year on year.
So just tracking inflation now.
But we've also seen government policies negatively impact house builders. Remember, things like Help to Buy massively inflated the price of some of these house builders. But a lot of those house builders' share prices have gone into freefall. One example would be Barratt Redrow, where the share price has fallen by almost 40% over the last year.
Yeah, and that's not an isolated example. And I think what's really interesting is that if you look at what these house builders have been saying over the last few months, quite a few of them are just pulling back from buying new land. They're just like, it doesn't make sense right now.
And I think that's a really good indicator of what the housing market state is, to see exactly what those house builders are doing. Because obviously they've got their finger on the pulse of what's going on, and they have been through many cycles in the past. So clearly we're moving into a cycle, or a part of the cycle, which isn't so good for them.
What they're all saying is, we need another Help to Buy scheme to get the market moving.
Well, you can bet there'll be another government coming along which will promise that.
What the government has promised is to build a lot of new houses over this parliament. So Labour came into office promising to build 1.5 million new homes in England alone over the 5-year parliament. And it seems almost certain to miss that target, and probably by quite a lot. Home building is struggling across the country, but in London, it's basically stopped. So in 2025, there were less than 6,000 reported starts in London, which is around 94% below the city's housing target.
Now, there are lots of problems which have curtailed the government's ability to build those houses. One of them is a lack of labour, skilled labour, in order to actually build the houses. Another is the rising cost of construction materials. So things like insulation, concrete blocks, even things like screws have gone up between 2021 and 2025 by around 50%. And of course, planning restrictions is still a problem. The government said it was going to try and change that situation, but in practice, that's been very difficult to do.
Yeah, in fact, in reality, I think the introduction of the building safety regulator, although done with the best intentions, has just added a whole nother level of regulation and planning restrictions, especially if you're trying to build big blocks of apartments and stuff like that that cities need. But probably the biggest issue facing new build developers is a lack of demand. And anecdotally, I've seen so many examples of new estates being built and then developers not being able to sell them and having to offer loads of incentives. So they're trying not to drop the headline price of the house, but they're saying, we'll pay your stamp duty, we'll pay any service charges for a few years, we'll throw in a car, whatever it might be, like really weird things because they don't want to drop the headline price, obviously. And I saw some stats which said that 25% of all the homes built over the past year remain unsold, which is the highest since the financial crisis.
So these are what economists would call structural problems, long-term issues, which are just very difficult to resolve. And you can't just wave a magic wand and hope it's going to go away. These are problems that are going to stick with us for a while. But this brings it all back to my favorite return on arse measure, which is my own multiple, which I created. Yes, it is trademarked. It's not really. But the idea is how much return do you get in percentage terms relative to every unit of grief which you have to put into the actual investment itself.
Sorry, so your arse is the denominator here?
Yes, it is.
Right, okay. Good, we've cleared that up.
But for property, notoriously, there is a lot of arse. It's a very illiquid market, so if it comes time to sell, it can take a long time and can be very expensive. It's very tax inefficient. Plus, the act of owning property comes with its own legal obligations. You can't just have a mold-ridden hellhole. You've got to ensure that the quality of the housing is up to a certain level. And maybe you're going to have difficulty with the tenants.
And now, of course, we've got the Renters' Rights Act, which I think a lot of landlords are not as across as they probably should be, because it does change a lot of the ways tenancies used to operate in England. There's no longer no-fault evictions. Tenancies don't have a fixed term anymore. You can't instigate a bidding war, supposedly, when you're advertising the property. And you've got to let them have dogs, which chew up the furniture, I think.
Not Teddy, he's very good.
Now, we're not saying this is a bad policy necessarily. It depends on your political views. But it's clearly an additional burden for landlords.
So I think this is why many people don't see property as such a good investment in the UK as it once was. I think there are certain pockets of the market which are still offering good yields. For example, student accommodation. I do have some clients who tell me that that's still pretty good in terms of yield, if you've got expertise in that market. But compared to something which is like equity, which takes very little skill, you just put the money into the market and leave it, I think that's much easier for many investors and potentially a much better return above inflation.
I mean, maybe people would say there are listed vehicles which can give you exposure to property. Real estate investment trusts, REITs. You can buy these things, they trade on the stock market. Although they're not always focused on residential property, a lot of them buy commercial buildings.
Yeah, I can see a list of about 5 or 6 of them in front of me. And generally, these investment trusts are trading at a big discount to NAV. I think that's true of a lot of the investment trust sector in the UK anyway. But the prices are languishing. And I think that's largely because of the factors we've discussed. So one way to get exposure would be via these types of investment trust. All you can really say about them is that the yields are generally quite high. We're talking about 7, 8% currently.
I guess you have to make a judgment call on whether the fund price is overcorrected or whether it's just anticipating a further downturn in the property market.
Yeah, those two chilling words, structural decline.
But presumably there are factors pushing the other way. Like we've said, there's not that many houses being built, at least versus the target. All else being equal, that's an upward force on prices, right? A lack of supply. There are certainly fewer houses being built than new households being formed in the UK.
Yeah, so maybe what we're seeing is a slow change in the equilibrium, which is going to put us back to where house prices are more reasonable relative to income and will be in a better place overall, particularly for new entrants. So maybe this is a healthy change.
Yeah, when I was doing the research for this episode, that was kind of my conclusion, is that if we're going to have a house price crash, this is the kind of one we want, where it's a slow burn, nominal prices don't fall that much, so banks don't go bankrupt. But in real terms, they slowly become more affordable as wages and inflation outpaces house price growth.
And of course, people won't like it because so much of UK wealth is tied up in housing. But it won't break the bank if it is this gradual readjustment.
It's probably cold comfort, though, for someone, let's say, who's in their 20s or 30s and looking to buy their first house. Whereas if you calculate the amount of time it takes to save up a deposit from average earnings, it's still basically as high as it's ever been. And then if you do manage to buy the house, the share of your income taken up by mortgage payments is still basically as high as it's ever been.
Yeah, I think it's got further to fall. And perhaps that'll redress some of the imbalance.
But are you not doing that thing that we did at the very start in the intro, where we said predicting a UK house price crash has always been a pain trade?
Look, it's not going to be in my interest if it happens, but I'm trying to think of it from the other people's point of view, from the point of view of people who are just entering a house market.
A lot of people say it's just so politically toxic for there to be a big fall in house prices that the government would never allow it to happen, which I think is kind of true. Like, the government really doesn't want a big fall in house prices, at least not a sharp one. But the government doesn't control everything. That's what people overlook.
But look, I think we will go back to this falling rate cycle, and we'll probably fall to around what? High twos, low threes in terms of the SONIA rate and the bank rate.
Over what time frame?
Well, we're talking about, 6 months, a year. It really depends on how long this crisis takes.
You think we'll be at 3% within 6 to 12 months?
I think it's possible. It depends on whether this situation does resolve. So if there's anything to watch, just read the Bank of England's monetary policy reports, because that'll give you the best read in terms of what the economics is telling you. And ultimately, that's what's going to drive house prices. Now, we mentioned the newsletter there. If you did want to get access to that, it's completely free. It comes into your inbox on a Friday. And if you want to learn more, just go to pensioncraft.com/newsletter.
Okay, today's dumb question of the week. Are short-term fixed rate mortgages a problem? So I guess if you think about a mortgage market and how lenders structure those loans, there's two extremes, aren't there? You could have everything as floating rate mortgages, tracker mortgages, if you like, where they just follow the bank rate with a spread on top so lenders can turn a profit. And at the other extreme, you have what you have in the US, where most mortgages are fixed for the duration of the term, let's say 30 years. And if you fix it at the beginning for 6%, that's what you pay until you've paid the bank back. But in the UK, we like to be a bit different. We've basically got a market somewhere in the middle, where most people fix for 2 or 5 years, despite the fact the mortgage runs for 25 or 30 years. And every time your fix expires, you go to the bank and roll it onto a new interest rate. So when we're looking at these different options, would it be better if we had this 30-year fixed rate system?
I'd certainly like to have an option for that in the UK. We very seldom see those 30-year fixes on offer in the UK, at least not at reasonable rates. But there is an interesting kind of theoretical side to this, which is that if you look at 30-year rates, in theory, the rate which you get is what markets would have priced if you roll over that short-term debt for a 30-year period. So the 15 two-year fixes would be roughly equivalent to the 30-year period with a bit of term premium on top. So in effect, what we're doing is swapping one thing for another. We've got the short-term thing, the US has got the long-term thing. They probably pay more for that long-term thing than we do for the short-term.
Yeah, they should do, theoretically, if the term premium is positive over the duration of the loan, which it usually is. But you said at the start that these long-term fixes are not often offered in the UK at cheap rates. Well, that's kind of because we're getting a discount for taking on interest rate risk, if you think about it in those terms. Because in the US, when they fix for 30 years, that might be at like 6 or 7%, even though their yield curve is not that different to ours. Whereas if you're fixing in the UK for 2 or 5 years, maybe you're doing it at 4 or 5%. You are getting a discount, but you're taking on more risk.
And there's also a question of control here. With a 30-year rate, what happens is that if rates fall dramatically, you get a huge wave of what people call refinancing, where people lock in that new lower rate. Whereas if you're on these 2-year cycles, effectively what you're paying is the floating rate. We call it fixed, but it's really not. And that means you're subject to the whims of the Bank of England, which is itself subject to those geopolitical whims. So a strait gets shut in the Middle East, and you end up paying more for your mortgage, which doesn't really seem fair. So I'd say what I dislike about this 2-year cycle is that it takes control out of your hands. You don't really get to control when you lock in. That's pretty much forced on you.
But there have been instances in the UK in the past where banks have trialed offering these long-term fixes, like 25 years or 30 years, and people have generally not wanted them. They voted with their wallets and opted to keep doing 2 or 5 year fixes because the rate the bank has to charge for the 30-year fix is materially higher because they're taking on the interest rate risk on your behalf, basically.
And if you listen to the Bank of England, this is a big deal for them because if you can lock in your mortgage for, say, 5 years and they're modifying bank rate, well, that's not going to affect the economy, certainly for borrowers, for mortgage borrowers, until those locked-in rates reset. So there is this lag for monetary policy, which is directly driven by these lock-in periods.
But surely the lag is much greater and the transmission is much weaker in the US, where they're fixed for 30 years. What you often see there when rates rise is people just unwilling to move houses because they don't want to take on a much higher rate loan.
I think that's true. And it's certainly discussed during the monetary policy press conferences. But there are other mechanisms by which monetary policy operates. That's just one of them, the mortgage channel. A big factor is going to be whether businesses can borrow cheaply, and the risk-free rate, which is set by the bank, will affect that. Another one will be the effect on the currency. If interest rates increase, generally that strengthens the currency. But I don't think you change all of this system in order to make it easier for the central bank to set monetary policy. I don't think anyone would think that was a good idea. The focus should always be on what's best for the people who live in the country.
I mean, if we're being really rational here, super rational economists, surely what we should favour is everyone is just on floating rate loans, where monetary policy acts immediately. The cost of money is what the cost of money is. You better account for that. No lags. Let's get on with it. We're all adults here.
But are we?
No, that's the problem. Thank you for joining us for Many Happy Returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out pensioncraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a Pensioncraft production, co-hosted and executive produced by Romin Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.